How are life insurance benefits taxed? Imagine leaving behind a safety net for your loved ones that not only provides peace of mind but also offers some surprises when it comes to taxes. Understanding how life insurance benefits are taxed can help you plan better and avoid unexpected costs. Most of the time, when a life insurance policy pays out after the policyholder's death, the money goes directly to the named beneficiary and is not taxed. This means the beneficiary usually does not owe federal income tax on the amount received. Whether it's a term policy, which lasts for a set period, or a permanent policy like whole or universal life, the payout remains tax-free. This is one of the main reasons many people choose life insurance. It offers financial support without adding tax burdens. If the beneficiary receives the death benefit as a single payment, the entire amount is typically tax-free. But if they opt to receive the payout in parts, like through an annuity or structured settlement, things change a bit. The insurance company might hold the money in an interest-bearing account. While the original death benefit remains tax-free, any interest earned on that money is taxable as ordinary income. For example, if the payout is $500,000 and it earns $50,000 in interest before payout, that interest is taxable, but the $500,000 is not. Life insurance proceeds usually bypass the estate, meaning they don't get included in the estate for tax purposes. However, if the policyholder is the one named as the beneficiary, or if they keep ownership of the policy at the time of death, the payout could be part of the estate. If the estate's total value exceeds the federal exemption limit, which is around $13,990,000 in 2025, estate taxes might apply. Proper planning, like transferring ownership to a trust or another person, can help keep the benefits out of the taxable estate. When a policy is transferred to someone else for money or other value, different tax rules come into play. If the transfer happens and the policyholder dies within 3 years, the death benefit might still be included in the estate. This is called the 3-year rule and is important for estate planning. Permanent policies with cash value, like universal or whole life, grow that cash tax deferred. This means you don't pay taxes on the growth each year. If you surrender the policy or take a loan against the cash value, any amount above what you've paid in premiums could be taxable as income. Withdrawals up to the amount of premiums paid are usually tax-free, and loans are not taxed unless the policy lapses or is surrendered with an outstanding loan. Premiums paid for personal life insurance are generally not tax-deductible. There are rare exceptions, such as certain business policies or court-ordered policies in divorce cases. If your employer provides group life insurance and the coverage exceeds $50,000, the amount above that is considered taxable income. To make the most of your policy, it's smart to name specific beneficiaries rather than just the estate, which can help avoid estate taxes. Choosing a lump sum payout keeps the benefit tax-free, but installment payments might generate taxable interest. For those with large estates, transferring ownership or setting up a trust can help reduce tax exposure. Regularly reviewing your policy after major life events ensures it still fits your goals. Remember, the death benefit is the main payout, and cash value grows tax-deferred. If you surrender the policy or borrow against it, taxes might come into play. Premiums paid are usually not deductible, but understanding these rules helps you plan better. Always check with a tax professional or financial advisor to tailor your strategy to your specific situation.